Welcome to Financial Revelations. I am David Safransky, your host. It's Thursday. You can always listen to me on Thursday on WCRF 103.3 in Cleveland. And we had somebody call this morning from West Virginia listening on the app. So Moody has an app that you can listen to from anywhere. You could download that at your favorite app download place, probably Apple or what's the other kind of phone? Android. Yeah, I've never had an Android phone, so I bought my first Apple phone in 2008. I had the first Apple phone, and it's because I had a slide-out keyboard on my old phone, and the letter S and F couldn't type, so I couldn't text anybody. Because it turns out there's a lot of those letters and words, and you need them. So I had to buy an Apple, and I've never looked back. I have Apple everything, essentially. You can also call us, 1-800-344-2534, or you can email Corey, K-O-R-Y, at epsf.com. All going to be scrolling down here. I just feel like I want to say it. We have a couple of questions today that I will answer for the podcast, and probably answer them on the radio next week, too, because there's a lot of current events going on right now. And, you know, I hate to do this to you guys. I don't know if you're as tired of this as I am. After a while, you regurgitate kind of the same information over and over again, and you feel like, am I just like burdening people with this? But I do hate to do this, but I have to. I got to talk about the Fed. The Fed raised rates yesterday, which I expected them to do. They take the next month off, so April, they take a vacay, probably for Easter, whatever. They come back in May, June, July. I think that they're raising May and June for sure. Maybe July. A lot of people think that they're going to cut rates this year. I'm telling you, unless we have a true blue banking crisis, which I don't see happening, they're not cutting this year. There's just no way. I just can't see the circumstances by which that happens. Now, it is true they have raised a lot at a record pace, but when the CPI comes out, it's still hot, and food is up 9% year over year. They cannot cut rates with food up 9% a year. Inflation hurts everybody across the board, rich, poor. It does hurt people at the lower end of the socioeconomic scale much more because they don't have room in their budget. I have room in my budget, so if Costco charges more for raspberries, I'm just going to buy them anyway, whereas other people are putting things back at the grocery store. They can't buy everything that they would have bought a year ago, so they need to handle inflation. It is critically important because Chair Powell raised rates. He was in at the Senate a couple of weeks ago, and the Honorable Senator Elizabeth Warren, I use that tongue-in-cheek, of course, that phrase. She said, well, you want unemployment to go up. That's going to hurt 1.5 million people. And his answer was, but inflation hurts everybody, 300 million people. So, yes, the Fed wants unemployment to get somewhere around 4.25%. That's true. And there are people at the end of that number that are going to lose their jobs. Now, there are 10 million jobs open, so conceivably everybody should be okay eventually, but we need a little bit of slack in the labor market. It's important for a lot of reasons. One is if you're a kid working at a fast food joint, they're paying you 18, 19, 20 bucks an hour to wash dishes. Well, can't have that. That puts inflation into the food supply. It basically embeds inflation, and we don't want that. We want to get that out of the market. That's a $14 an hour job. You're never supposed to support a family of 5 on working at a fast food restaurant. So if you are, I don't know what to tell you. Go back to school. We got to go back to school. We got to get trained, got to do something. A lot of people think because, Corey said, I didn't think Chair Powell was a real person because of the way you say it. That's what he looks like right there. Chair Powell. My friend, Chair Powell. So not only did the Fed raise 25 basis points, but banks significantly tightened credit. You probably read about this, but a couple of banks went out of business. The Fed had to take them over and guarantee deposits. that is not a good thing. We do not want that to happen. It's and in the process, other banks that aren't getting taken over, which is 99.99% of banks, they tighten credit up because they don't want to take a lot of risk right now. But deposits are insured to $250,000 per account title. And what that means is if I have an account and my wife has an account and then we have a joint account, we have $750,000 of insurance on our deposits. Well, the Fed came out and said, well, we're essentially going to secure all deposits right now and insure them. And then they kind of backed away from that, but there's an implicit guarantee, an implied guarantee going on right now. And this is a bad idea because there's this philosophy, there's this thought called moral hazard. And moral hazard is the idea that you would avoid catastrophic loss because of the consequences. And if there is no chance for catastrophic loss, you're not going to try and avoid the consequences and you'll take unnecessary risk. So we're allowing people to take risks that could put depositors at risk and not have any consequences. That's moral hazard. We don't want that. So we don't want to insure deposits. People who have a lot of money at banks have to be more creative on how they do it. Look, if you've got so much money that you don't know what bank to put it at, that's a problem you're going to have to deal with, and you'll probably be just fine doing it. So, but when those two banks went out of business and got taken over and put into receivership, interest rates dropped by a full percentage point in the market. So bonds that I was buying for 4.5% interest a week before are now at 3.5%, and that's not what the Fed wants. So it's really working against the Fed to do this, even though the tightening up of credit does help them. They want rates higher so that they can slow down the economy. In fact, I just looked at a securities-based line of credit for somebody. That rate is 8.5% today. That is a really high. Those were in the 4s early last year. That's how much rates have moved. So consequently, I haven't bought a bond since the banks started. Those two banks went out of business and the Fed got involved and the Treasury Department got involved in the market. We have not bought a bond. I am waiting. I'm going to wait until rates kind of fluff up a little bit and pop up again before I buy any more bonds. And I do think that's going to happen. Once we get a little bit of time and distance between us and SVB and Signal Bank, I think rates will normalize back to where the Fed wants them. And right before I walked in here, I was watching somebody that I respect highly who said he thinks the Fed is done. I just don't see how the Fed could be done. And Chair Powell, right there, he even was asked at the press conference yesterday, is anybody planning for rate cuts this year? And he said that in nobody's chart is a rate cut happening this year. And I think he's telling the truth. I don't think there's going to be a rate cut this year. They cannot risk inflation getting back out of hand. And it was out of hand. It was never transitory. So, and I don't think that he lied. I think he was hopeful that it was transitory, but the administration keeps dumping so much money at the economy that I don't see how it ever changes without being slowed down. And because of that, I do think now that we are going to go into a recession late this year that will go into early next year, into the presidential cycle, and I think we're going to have to cut rates in 2024. I don't know when that's going to happen. I have no insight as to how deep the recession could be. It just depends on a lot of things, especially how stingy banks are with credit. If banks get really stingy with credit, if they're just not willing to offer credit to people, for instance, in 2008, in 2009, if you had a leased car, they wouldn't release it to you. You couldn't get a car lease in 2009. Nobody was offering that kind of credit. Didn't want to risk it. If things like that happen, I think it's going to be a deeper recession. If the Fed can get out in front of and stay out in front of the bank issue, it's not a crisis yet, but the bank issue, then I think it could be shallower, but it's really going to depend on banks. And, one of the things in 2009 that was kind of unique is that the Fed was trying to get banks to lend money. They just wouldn't do it. The government had forced all these kind of marriages of convenience with different financial institutions, and they were so busy kind of assimilating banks and institutions that they just said, you know what, we're going to take a pause. And the Fed could not get them to loan money. It wasn't until banks started loosening up on credit restrictions that the economy really recovered. So that leads me to my first question that we got. Is my money safe in a bank? And the answer is, yeah. You have $250,000 of insurance no matter what. No matter what the Fed says, you have that. And if you have more than $250,000 in one bank, I might divide it up in between account titles, or use another bank. I happen to like slightly larger banks myself. So if you have a small community bank that you just is maybe it's around the corner from your house, so it's convenient. I don't know that I'd pull my money out of it if you had less than $250, but if you got more than $250, I would put that money in another bank. I think it's just safe. So banks in total, I think, are safe. The thing that happened at Silicon Valley Bank was really due to an inexperienced management that was run by idiots. They didn't know how to manage a bank, and they didn't know how to manage risk, and they were more interested in diversity of hiring than they were in diversity of risk, and that's what cost them the bank. Barney Frank, who wrote Dodd-Frank, sits on the board of directors of that bank. That ought to tell you something. He wrote the bill, co-sponsored the bill that changed banking because of what happened in 2008. And yet, that happened to his bank. Go figure. The next question is about I-bonds. Somebody has $10,000. They want to invest it. They're thinking about I-bonds. They don't want risk. I guess if you only had $10,000 to invest, I don't think that I would do I-bonds. Number one, the pillars of financial planning begin before you go to invest in anything. So one of the pillars would be, what's your budget? And from your budget, you just determine your 3 to 6 months of your emergency fund and what that number is going to be. And that's what you got to have in cash. And I-bonds are not the place for an emergency fund because you can't just take your money out of an I-bond. You got to sell it. If you don't own it for 5 years, there's a slight penalty. So I don't think I would begin with I-bonds if you've never invested before. I would begin someplace else. Do the pillars of financial planning first. And the last thing that you're going to do is you're going to invest. But you got to have and know a budget. You got to have and know your emergency fund. You got to have your consumer debt paid down. And risk, believe it or not, a little bit of risk in a portfolio goes a long way. And there's a chart that I'll put up sometime. It looks like a Nike swoosh. And what it really does is it says, look, there's an appropriate level of risk that will add a lot of rate of return, but not a lot of downside if you just have the appropriate levels of risk in there. One of the big things that I see with what I call homeowner portfolios, do-it-yourselfers, is they either have way too much risk or not nearly enough. And so if you have way too much risk, you get punished in the market. And then you say, well, I'm not going to invest because I always lose all my money. And that's because you got too much risk. You're taking it all in one place, or you're just taking silly risks. And then other people who have not enough, they say, well, I would invest, but I never really make any money. Well, that's because you're not taking the appropriate amount of risk. So there's a good balance in there that we got to strike. And it doesn't matter where your balance is. There's no right or wrong answer. I could just tell you what will make you more money and what will be silly. So as we go through that process, the last thing we're going to do is we're going to invest. So for the person who has the I-bonds, never invested before, let's start at the beginning instead of starting at the end. Now, when I was a kid, we would travel. We didn't do that a lot, but it'd always be in a car. My brother and I were impossible to be around in a car. You wouldn't have wanted to do it, neither did my parents. So they would give us these maze books, and I would always win. And that's because early on I figured out, well, on the way into the maze, there's all kinds of different paths that you could go and get lost. But if you know where you want to end up, If you start at the end and work your way backwards, there's only one route. And so part of a financial planning process is figuring out where do you want to end up, and we can work our way backwards, but we still got to work the process. So if you've never invested before, don't start with I-bonds just yet. I'm not saying that's where you might not end up, but it's not where you're at right now. So I'm going to stay on the quick hits this week was also about the banks, because I am getting bombarded with questions about the banks. Are they safe? Should I take all my money out? You should not take all your money out. We're not there yet. We weren't even there in 2008. So I think we're going to be fine. I liked the market as crazy as that weekend was. The market responded fairly well to the banking crisis. We're still in our range. We have a support level that we haven't gone under. We have a resistance level, a number that we haven't broken through. And because we didn't go down or even get near that lower level, that support level, I think the risk is higher right now. I think we're going probably a little higher in the near term. I don't think anything's going to break us out of the range because I haven't seen anything to do that yet. But I'm going to stay on the bank, so pay attention to the quick hits, which are only like a minute and a half, 2 minutes. And then, of course, we do this every week. So we'll be back to you next week. And I promise next week I'm not going to talk about the Fed. What I really want to do is answer your questions. So email, text. Well, you can't text us, but you can call questions. You can also call the radio station. I bring over some questions from the radio station, too, that I really like. So any way you want to get a hold of us, you can do that. I am David Safransky, a real American, a true red-blooded patriot, and the voice you can trust.